Good morning everyone and welcome to another RF Crypto video. Today's markets have gone down by 2%. You can see Bitcoin is down by 1.3% and Ethereum is down by almost 2% as well, with BNB down 2%, Cardano 3, Solana 4, Dogecoin 3 and Polkadot 4. And this is mainly due to the fact that the Federal Reserve had a meeting and they released their minutes in which they had said that they were going to continue increasing interest rates because inflation is not where they want it to be, which is at 2%. It's currently sitting at around 8.7, 8.8%. And the very few tools that they have to combat inflation, they're using it. And one of these tools, which is a very powerful one, is increasing interest rates. So they are going to continue increasing interest rates. And because interest rates are going up once again, that means that money becomes more expensive because interest rates are the price of money. So when you borrow money from a bank or a financial institution, what you pay is interest rates. And because of that, there will be less money in the market to invest in risky assets such as Bitcoin and Ethereum and other cryptocurrencies. In addition to that, money is currently flowing out of the crypto market into stocks and into the dollar because the people feel that with increasing interest rates, it is better to have dollars in order to earn more interest in their own accounts, as well as increasing interest rates mean that money becomes tighter. And when money becomes tighter, people want to invest in safer assets and stay away from risky assets because there is a greater propensity for them to go down. So when interest rates go up, people become more risk wary and become more risk averse and tend to divest from riskier assets and take that money and put it into more safe assets like stocks, bonds, and the dollar. Looking at the price of Bitcoin, we see that the price of Bitcoin had touched the $25,000 resistance level, which is the current resistance level at the moment. However, it steadily dropped after trading laterally for about 1 or 2 days, and it almost touched the $23,000 support level. However, the bulls didn't let that happen, and they bought up some Bitcoin through this dip, and the prices have risen a little bit. It went as low as 23,184. Now it's standing at around 23,555. There was a little test towards this support level. However, it didn't quite reach it enough to break down to 22,000. So now it's currently trading at a stable pace, and it is heading to 25,000 if nothing else goes wrong. And as I said before, this decrease here is due to the Fed stating that they're going to increase interest rates to combat inflation, and that translates to people moving money from riskier assets like crypto to safer assets like stocks and bonds. On to some news. 3 cloud providers account for over 2/3 of Ethereum nodes. So the majority of the 4,653 active Ethereum nodes are in the hands of centralized web providers like Amazon Web Services, which could expose Ethereum to central points of failure. So if you have most of the nodes running the network centralized in one space, or most of it in one space, it makes it easy for it to fail because there's a single point of failure towards most of the network. This means that it's not as decentralized as we want it to be. If we look at the chart here, Amazon has 52.1% of all Ethereum nodes, with the rest being distributed, and the next big one being Hetzner Online GmbH with 16.9%, which is a lot lower than 52.1%. So if Amazon Web Services go down, a big portion of the Ethereum network might go down as well. Or if it doesn't go down because other networks are active, then it will become a lot slower and gas fees will rise very quickly. While the distribution of cloud services providers become more decentralized among the bottom third of providers, there is concern that the high cost nature of node infrastructure may leave Ethereum vulnerable, and it is a very, very big barrier to entry in order to become a node provider due to it being extremely expensive. So not only is it like that for Ethereum, node distribution issues experienced by Solana are pretty much the same, with Hetzner taking up 42% of hosted nodes on the Solana network, followed by OVH at 26% and Amazon Web Services at 3%. So Ethereum isn't the only cryptocurrency to face this sort of issue. Other cryptocurrencies and other platforms such as Solana are also facing this issue. And for the sake of the network, it's good if they can solve this by increasing decentralization and making node infrastructure more accessible and cheaper, which will allow more cloud providers to get into the node servicing of Ethereum and Solana. Furthermore, data shows that nodes are most geographically concentrated in the US with almost 50% and Germany at 13%, accounting for nearly 60% of distributed Ethereum nodes worldwide. As such, government intervention from one of these two countries could severely impact Ethereum's decentralization at the node level. Imagine if in the US, node infrastructure or hosting nodes becomes illegal. It won't happen, the probability is very little, but imagine if it happens. Ethereum's network will suffer greatly. Hopefully, there are some inroads being made towards decentralization, and especially with Ethereum 2.0 coming up, there is a lot of hope that it will aid decentralization and it will make the network quicker and safer, and in that sense, it will disperse the risk that we're currently facing at the moment. It's not a massive risk, but it is something to be aware of. As I spoke about before, Bitcoin and crypto markets dip on release of Fed minutes. So they released the minutes from their July meeting in which the agency said that it would continue to hike interest rates in order to tame inflation. Because of this, Bitcoin's price dropped 0.9% in the hour following the Fed's announcement and was down 2.4% for the day. Ethereum was similarly down 2% for the day. The stock market also similarly dipped, Dow Jones by 0.1%, S&P 500 by 0.2%, and Nasdaq by 0.6%. And Nasdaq is composed of tech stocks, which are more risky than your traditional stocks. Therefore, the decrease was more than the other two. So the Fed says that inflation was still too high despite the labor market being strong and unemployment very low. And there's no evidence that inflation is going to subside just yet. And because it's a lot higher than its long-run goal of 2%, they use the tool of increasing interest rates to try and tame inflation. And this has an impact in the crypto market because when you increase interest rates, there is less availability of free money, borrowing money becomes more expensive, and everything just becomes more risky. At the same time, having money in your account becomes more attractive because you earn higher interest rates in interest-bearing accounts. So what do people do? They remove money from riskier assets like crypto, they place it in stocks and bonds, which now potentially will offer higher returns, as well as in savings accounts and in other interest-bearing accounts in their banks, due to the fact that returns are now higher there. And that's why the price of Bitcoin and other cryptocurrencies fell, merely due to capital flight from the markets. Also, because a lot of people are holding the dollar due to higher interest rates, this has helped the dollar increase in value immensely. The dollar to euro exchange rate, which was about 1.13 a couple of months ago, is now at 1.01. Similarly, the dollar to pound exchange rate, which was 1.3, now is 1.2. So the dollar is extremely strong at the moment, but I think this is temporary. When things become normalized and when the geopolitical risk subsides, everything will quite return back to normal. These are cycles, and with every cycle, we just have to ride them. So Australians buy fuel and chips with crypto assets across 175 fuel outlets. Convenience store and petrol station brand On The Run has launched crypto payment support across all 175 of its petrol stations and convenience stores across Victoria, South Australia and Western Australia. And this move is a collaboration between OTR, Crypto.com and Datamesh. So Crypto.com provided its pay merchant service as a payment settlement layer, while Datamesh has provided the point of sale terminals where the actual transactions take place. So Crypto.com's Asia Pacific General Manager stated that the crypto payment service is operationally ready to scale much further. What happens now is any merchant, whether you're a cafe owner or someone who runs thousands of stores, could just plug and play. So this opens up the door to microtransactions in crypto, and let's say you want to buy a cup of coffee or a donut with your crypto wallet, you can do so very easily, and it's very quick, convenient, and with low fees. So adding to OTR's 175 stores, its parent company Peregrine Corporation intends to roll out the crypto payment services to another 250 retail sites across Australia, such as Subway, Oporto, and Krispy Kreme. And this is a very, very big step for Australia. They're way ahead of everyone else in terms of crypto. There are a couple of crypto companies operating in Australia now. At the retail level, crypto payments and crypto transactions are taking place actively. and it's going to be scaled at a much wider scale, which is quite exciting, and it's something that other countries should think about and implement as well. So Australia, very well done. They are doing quite well in the crypto space. Not only have they implemented the crypto payment system, but they have also released a ADC stablecoin, but it's purely for institutional purposes at the moment. However, if this stablecoin, which is pegged to the Australian dollar, gets opened up to the retail market, it would explode in use, and a lot of people would adopt crypto for payment because it would be the same thing as using their debit card or credit card, as the ADC stablecoin is pegged 1-to-1 to the dollar. So exciting times ahead for the Australian crypto market. I can't wait to see what's next. CBDCs are the only solution to smooth continuation of the monetary system, says the European Central Bank. So as physical money loses its economic fitness and cryptocurrencies and big tech continue to make inroads in the financial system, the only solution to guarantee a smooth continuation of the current monetary system is to introduce CBDC. So ECB's paper stated that there is no regulatory alternative that promises to eliminate the threat to the two-layer monetary system, which is cash and digital. Since cash is only available in its physical form, it is by construction not fit for the digital age. They also stated that the importance of central banks achieving the right level of CBDC take-up was stressed, but the authors also looked at potential regulatory action that could help CBDC achieve their goals. So they need to make sure that the regulation is up to par, that they can make sure that there are anti-money laundering measures in place, that it's easy to use for the average consumer, and protects their privacy as well. And pointing to privacy, it was identified as an area where more research is needed, as was end user preferences for CBDC functions. Privacy is extremely important because we don't want the central banks and we don't want private companies to monitor what we are transacting and what we're using our stablecoins for. And this is a point of contention and something that needs to be ironed out before CBDCs become the norm for payments in the world. And with that, we come to the end of today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, and cheers.